This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 404 was produced on November 30th, 2023. I'm Eric Townsend. Rosenberg research founder David Rosenberg returns as this week's feature interview guest. Rosie's two strongest conviction trades are long duration and long gold. We'll discuss why, along with all the other usual macro suspects, including recession risk, whether the bear market in stocks is over, Rosie's inflation outlook, and much more.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, November 29, 2023. The S&P 500 futures were down 18 basis points to 45.59. The relentless advance since October has finally stalled. We'll take a closer look at that chart and the key technical levels to watch in the Postgame segment. The US dollar index down 100 basis points to 102.84. The January WTI crude oil contract up 99 basis points to 77.86. We'll take a closer look at that chart in the postgame, and Eric will have the EIA inventory data. The January RBOB gasoline up 227 basis points, trading at 2.25. The February gold contract up 268 basis points to 2,067. Important to note the contango in the contract roll contributed to the advance. Copper up 160 basis points, trading at 382. Uranium up 19 basis points, closing at 80.90, printing a new year high as the trend continues. The U.S. 10-year Treasury yield down 15 basis points, trading at 4.25. The decisive reversal from 5% is clear, but is it a new trend? The key news to watch this week is the ISM Manufacturing PMI. Next week, we have the ISM Services PMIs, the Bank of Canada Monetary Policy Statement, and the jobs numbers. This week's feature interview guest is Rosenberg research founder David Rosenberg. Eric, why did we invite David back on as a guest this week?
Patrick, Rosie is an icon in the industry, very well known for his daily Breakfast with Dave newsletter, which has lasted, some number of decades, and I don't even count it in years anymore. The last time we had him on, his call was the bear market in stocks is not over yet. Recession's still coming. It ain't over till it's over. Needless to say, this relentless rally that we've seen in stocks seemed like a good time to get it back and find out whether or not his view has changed.
Eric's interview with David Rosenberg is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Rosenberg research founder David Rosenberg. Rosie, it's great to get you back on the show. Last time I had you on, the message was, hey, the bear market is probably not over. The final low is probably not in. And the people who are celebrating that it's all unicorns and roses from here probably have the message wrong. I still want to believe that's true, but gosh, look at this S&P chart. What do you make of this?
Well, I think that it has to be said that we have not made a new high for the S&P 500, despite all the efforts and achievements by the Magnificent Seven. It's been almost 2 years now that we last had a peak in the broad market. So I find it fanciful when people say to me that we have entered into a new bull market. I think that we have just been range trading for the better part of the year. We know that when you look at the S&P 500 equal weight index, which really is a proxy for the average stock or the median stock, it's done diddly squat all year long. I mean, all the heavy lifting has been in the mega cap tech stocks. And this remains one of the most concentrated markets that we've had in our hands since the late 1990s with the dot-com and broad technology craze. So I would say that there's no evidence, notwithstanding the fact that we've had a nice seasonal short covering rally, that the bear market is over. I think that we've really just been sitting on a shelf. And the market seems to believe that we're going to be in a prolonged soft landing because we've been in one all year long. So I think that the big surprise, especially for a market that's pressing up against a 19 forward multiple, that the recession that was delayed was not derailed. And I think that you're going to be finding in the next 4 quarters, these earnings estimates that you could say have helped underpin the market are going to be ripe for a sequence of declining expectations on the earnings side. So the bottom line here is that with it still not priced in really to any asset class, maybe it's starting to filter into the oil market. What more important price is there than the oil price, which is telling you a story, I think, on the demand side? So I think that the bear market is still here. We've had intermittent rallies in the context of what is still a bear market. And the answer is no, especially if we get a recession, which I believe is the base case. I think that the ultimate lows still lie ahead.
I tend to agree with you, but just to take the other side of the argument, since that's my job as a journalist, one of the things that the bulls seem to be celebrating is this narrative where they're saying, okay, look, we're past the moment of peak rates. The fight against inflation is over. The Fed's got it under control. We've seen peak rates. Everything's going to get better from here. And so far as I can tell, all of that is based on exactly one CPI print coming in a whopping 0.1% below consensus expectations. So I'm not quite sure why all the hopium, but that's the narrative. What do you think about peak rates? Is that really true? Is inflation under control? And if inflation's under control, is it because the Fed succeeded, or is it just because maybe a hard landing is coming and inflation's coming off as a natural function?
Well, I think it's all the above. There's no doubt that in the pause period that really goes from the last rate hike to the first rate cut generally produces an everything rally. You get rallies in equities, you get rallies in fixed income, you get rallies in commodities. And so nothing here is really that surprising. So you get this rate relief induced rally, and we've been seeing that now for, call it the past several weeks, maybe the past couple of months. I think that inflation is yesterday's story. And I think inflation has already come down dramatically from over 9% to barely over 3%. There's only been 4 other times in history when inflation fell this far, this fast. And actually, in those 4 other periods, it coincided or led to an economic recession. So there's a bunch of things that have happened on the inflation side. On the beneficial side, of course, have been the restoration of global supply chains, and we've seen the labor force participation rate pick up, productivity has been improving. So a lot of the bottlenecks on the supply side that helped create those conditions for 9% plus inflation in the summer of 2022, well, those conditions on the supply side have largely faded away. On the demand side, you're seeing 2 things happening. You're seeing the fading of the fiscal stimulus and the impact that that had on demand. And at the same time, the lagged impact of the Fed tightening, which also is having an impact on demand, and we haven't seen the full impacts there yet. I think that for people that look at the inflation side as a reason to be bullish on equities, what I can say is that you can argue that inflation coming down should mean that interest rates come down, and that should be very good news for an expansion in the market multiple. But you see, it's not as if we're coming at this with the multiple at normal levels. I mean, you're talking about a price earnings multiple pressing against 19, when historically the multiple is closer to 15 or 16. So I don't really think that if you're bullish on equities, you want to be making your bullish bet on further multiple expansion from where we are today. If we were at a normal multiple, I would be more constructive on the market. And the next thing is, what does declining inflation mean? It means that price change is slowing down. And the price change slowing down means that revenues, most of the items in the CPI and in the producer price index, that reflects some companies' revenue stream. So you can't have it both ways. In ordinary times, with a normal market multiple, declining inflation, declining interest rates would lead to an expansion of the multiple. But I shudder to think that that's going to happen from current levels. They're just too inflated as they are. And on the other hand, you have to say, what does this rapid decline in inflation mean for pricing power? And pricing power is correlated with revenues and profitability. So that's where you've got this break in the link in the bullish argument over the inflation. The inflation had been signaling the improvement that we've been seeing on the supply side. The next leg is what we're going to be seeing on the demand side. And that's going to feed right into what I said at the onset, which is lower profits, not higher profits. I mean, the consensus thinks we're going to have 10% profit growth next year. And I see that as a virtual impossibility. And what the inflation numbers are telling you is that pricing power in the corporate sector is receding. And that is not anywhere close to being fully priced into the stock market.
On the fixed income side, one of the messages we're hearing from the bulls, at least, is, okay, look, buy duration and buy it in size. Peak rates is behind us. You can't go wrong buying bonds. Just buy duration. Back up the leverage truck. What could go wrong in that story?
I'm not really sure what can go wrong unless somehow out of thin air, we're going to recreate a new inflationary environment. That is certainly not going to be happening in the next year. But if you can dream up a scenario where inflation stages a miraculous comeback, that would definitely kibosh the bond rally that we've been seeing over the course of the past, say, 4 to 6 weeks. If we get some sudden growth reacceleration, that would also cause yields to back up. Certainly would cause these expectations of Fed rate cuts to come out of the market, but you have to ask yourself the question, what's the catalyst for that? What is the catalyst for a re-acceleration of economic growth? I don't see it, at least for the next year. Now, we can talk about bond supply and fiscal policy, but the reality is that that's all well known. Everybody knows about bond supply. Everybody knows about the structural deficits. So that's not really a surprise. So we'd have to really get it from what is it that matters most for the Treasury market? Economic growth, inflation, and Fed policy. And we have a situation where Fed policy is already extraordinarily tight. The Fed funds rate is almost 300 basis points above the Fed's own estimate of neutral, and we have a simultaneous contraction in the money supply and bank credit, which I think is inherently deflationary, not just disinflationary. So somehow out of all this, out of contraction in money supply, out of the pullback we're seeing in bank credit, we'd have to somehow see this downward momentum. And it's not just 1 month. The downward momentum in the trajectory of inflation has been breathtaking. I said before, only 4 other times has inflation come down from a peak. Not even Paul Volcker saw this. And so those would be the conditions that would cause me to turn bond bearish. A reacceleration in growth, we have to identify what that catalyst is going to be. I just don't see it. It ultimately will come from more stimulative policy, either here or abroad. And what is going to stop this downward trend in inflation? When you consider that we haven't even seen the full impact of the rental deflation. The deflation in the multifamily housing market in real time is yet to really translate into the CPI numbers. That's going to be a big story for next year. And a third of the CPI is residential rents, and 40% of the core is residential rents. And if you could build me a story that we're going to have declining vacancy rates and a resumption of an upward trend in rental rates, well, that would cause me to go back to the drawing board. That's going to exert a downward pull of significance on headline and core inflation in the coming year. And don't forget that there are important spin-offs through the entire cost structure from what's happened with the oil price. Now, remember that when the Saudis extended the output cuts, And then we had the onset of the war in the Middle East. The mantra amongst the oil gurus, I mean, the people that only get paid to forecast the oil price, were telling us we're going to be getting to $100, $120 a barrel. We're at $75 a barrel. I mean, we have oil is in a bear market. Oil is back in a bear market. It's more than 20% below where it was at the end of September. And that's going to have all sorts of spin-off impacts on headline and core inflation for the next several months. And we have to ask ourselves the question again, this comes down to the economy, and it comes down to demand, and then connect the dots to the outlook for corporate profits. Why is it that oil prices are going down right now, given the constructive supply outlook? And it's because demand, global demand, is contracting. I was actually stunned at the latest data that came out for U.S. consumer spending to see that over the past year, volume consumption in the United States of gasoline and motor fuel is down more than 2% for a nation that has about 140 million drivers. So what does it mean for the economy when people are only filling up their cars with half a tank of gas? What is that telling you about the state of demand? So I'm not surprised. I'm not surprised by what the bond market's doing. I'm not even, frankly, really surprised by what the stock market's doing, because so much of the stock market is psychological and momentum. And now you've got the Santa year-end rally, and everybody's got FOMO on the brain. So it's not always fundamental when it comes to the stock market. There's just so much psychology and emotion that's involved. But for the bond market, I can see exactly what's happening. They are responding to what they're seeing in real time, to key aspects of the demand side of the economy.
Going back to your view on equities, it seems to me the VIX is at a pretty darn low level right now. There's also a pretty significant bullish option skew. So puts are cheap right now. I would think, given the view you're describing, if there's a Santa Claus rally, probably the way to fade that is to be buying puts on the cheap. Would you agree with that? And is that a strategy you're recommending?
100% agree. I mean, the VIX, below 13 is a 1 in 6 event. And you can see that degree of complacency, coinciding with all the survey data right now, the Investors Intelligence poll, Investors Intelligence, that seems like an oxymoron. But you have now more than 2 bulls for every bear in the II poll, the American Association of Individual Investors. The same thing, 2 bulls for every bear. So you've got sentiment is at an extreme level. The CNN Fear Greed Index is now flirting with extreme greed. In just over a month, it's swung dramatically. But like I said, that's the stock market for you. And you have excessive sentiment and excessive valuations. And right now, downside insurance is dirt cheap. And I would completely agree with you that if you're looking at those pricing of put options, they actually look very attractive right now.
Going back to the oil side, in the data that you follow, is it possible to tune out the growth of electric vehicles so that we could see whether or not this reducing demand for motor fuels is really coming from economic weakness versus potentially just a shift to electric vehicles?
Well, that shift is taking place at really a gradual pace. It's not going to explain. Electric vehicle, by the way, the EV consumption has really disappointed all of the bullish projections that were out there in recent years. They've fallen well short of estimates. But you see, that's really you could argue, a longer term factor that could suppress the price of oil, 100%. It is not an explanation for how in the span of less than 2 months, the price has plunged more than 20%. That's not electric vehicles. It cannot possibly have an impact like that over a short period of time.
Let's turn now to the market impacts of the changing geopolitical situation, because just a couple of months ago, we had a narrative that kind of went, okay, unconditional support for Ukraine forever until the war is won. That seems to have changed to Zelensky, time to negotiate, we're done supporting you. The Israel-Gaza war that broke out and, as you said, had everybody afraid of oil prices going to 150. Well, oil prices have gone the other way. We now see there's been an extension to the ceasefire. Seems like maybe things are starting to calm down a little bit. I was originally thinking there would be a re-escalation there as soon as this ceasefire was over, but it seems like they're extending it, so I'm not sure what to make of that. And then there's the question of whether or not a Taiwan invasion from China is still a significant risk on the near horizon. How do you see all of this, and how do you interpret the geopolitical impacts on markets?
Well, it's always very difficult to invest around geopolitics. And as we saw with this move down in oil, because you always think the first thing you think about with geopolitical risks is that a premium gets built in the oil price, especially when it is about the Middle East. That didn't happen this time. So if you turn bullish on oil, because all the experts told you that you should as a geopolitical hedge, that hasn't worked out so well. I can only say that the world is in a troubled place. I guess we could argue it always is, but it is now several deviations away from any norm that we've been accustomed to over the course of the past 3 decades. The only way I could see that you really want to play this from your portfolio is in having exposure to aerospace defense stocks and cybersecurity and the like. I think that there is going to be a secular bull market globally in defense stocks because government budgets aimed at bolstering defense expenditures, the military budgets, they're going up around the world, even in former pacifist countries like Japan, for example, radically bumping up its military budget, and we're seeing that globally. So that, I think, is an investable theme that transcends the business cycle. But outside of that, whether or not Israel starts again in Gaza, which we don't know how that's going to play out. So far, this has just been a few days of the hostage release. But I recommend to the people that are on the call to not formulate your investment decisions based on geopolitics. It's not really something you can invest around. I would only say, and I was saying this before, what happened on October the 7th was that global military budgets are on the rise. That's where a lot of spending is happening, and that gives this sector earnings visibility that has nothing to do with whether we go in a recession or not. So that's the only real natural play on everything we're talking about right now. I mean, we've been talking about Taiwan for many years, and we know the threat. We know that the U.S. has a red line when it comes to Taiwan, but I wouldn't be. There's too many other investable themes right now that we can concentrate on with more certainty than to be talking about how do we reallocate our asset mix or our sector orientation because of geopolitics. I would just say that the natural way to do it is by making sure that within your equity portfolio, you have exposure to aerospace defense, and maybe not just in the U.S., although they have the best companies, but globally.
Are there any other themes you want to mention that you do favor?
Well, we talked about earlier about long duration bonds, and that's my highest conviction trade for the coming year. And I would just say that if we can accept the legendary Bob Farrell's rule number 1 on market mean reversion as gospel, then what I can offer is that mean reverting things like the super stretched homeowner affordability ratio. Housing is more unaffordable in the United States today than it was at the peak of the bubble back in the mid-2000s. If you mean revert the homeowner affordability ratio, which is a mean reverting series, if you mean revert the razor thin equity risk premium, which is a mean reverting series, If you mean revert the inverted yield curve itself to the norm of the past 2 decades, you do the math on this, and it would require an ultimate move down in the Fed funds rates to or below 2%, the 10-year Treasury note below 3%, keeping in mind that I'm not talking about going to some pre-COVID situation. Before COVID, the 10-year note was sitting below 2%. But I think that the conditions are there for the 10-year Treasury in the next 12 months to get to 3% or lower. And the long bond would then come down to 3.5% or more than 100 basis points below where we are today. Now, if I'm right on this, and here I'm not even talking about other things like where's inflation going, I'll get into that in a second. But I'm talking about mean reverting critical ratios that are mean reverting series. And every single path is blazed with a return to lower interest rates, not to zero, but to much lower than we are today. And if I'm right on what the long bond is going to do, the 30-year Treasury bond, because of the price convexity, the total return in the next year is going to be 25%. People don't realize, people say to me all the time, who would want to buy a bond and hold on to it for 10 years or 30 years? Well, I don't know. Who buys a stock and holds on to it for 10 or 30 years? I mean, the equity market also is a long duration animal, but people are buying stocks with a 1-year view, 3-year view, sometimes a 1 week or 1 month view. If you have a 1-year perspective, I think that the chances that, and remember, keeping in mind that this will be the 3rd consecutive year where the Treasury market delivered a negative total return. Negative total return for 3 straight years is unheard of. But as Herb Stein famously said, anything that can't last forever, by definition, won't. And the bear market on bonds is not going to last forever. And I would say that for the stock market to match that potential return on the long bond, the S&P would have to finish 2024 north of 5,600 or a 23 PE multiple. And I don't think that's going to happen. So I think the long bond is going to be a great place to be. And I even say that after applying a premium for fiscal policy risks, and namely what we all talk about, which is the increasingly structural nature to the deficits and the debts. Even with that, because there's such a strong cyclical component to market interest rates, that I think that the long bond gets to 3.5, the 10-year gets to 2.5. And my message here is that all roads are going to lead to a reversal of this bond bear market in the coming year, and I think in fairly spectacular fashion. And when I trace out what rents are going to be doing, if you get the rents right, you're going to get the inflation story right because it's so dominant in the CPI data. We map out how residential rents in the CPI are going to follow what's already happening in real time, because rents in real time have already deflated 4 months in a row. That gets reflected in the CPI with a lag. And then we got to trace through what the producer price index is telling us, because that leads the CPI. And you have a situation where at the back end of the production curve and for semi-processing goods, the core indices are running negative on a year-over-year basis. And then we got to tack on what the implications are of this downdraft in oil, which is going to have an enormous impact going forward on transportation costs. So we map all this out, and I think that by this time next year, inflation is going to be somewhere between 0 and 1%. 0 and 1%. And there's no way that the economy is going to be able to withstand nominal yields this high with inflation that low. And the Fed will respond, and it'll be too late, as it normally is. But I think that my strongest conviction call is for the yield curve to resume its more normal shape. That's really at the essence here, is that we've had an inverted yield curve since the summer of 2022. And we only have a yield curve inversion because it's very abnormal when you think of the time theory of money, the time value of money. The yield curve is positively sloped 85% of the time. We are in an abnormal situation when it comes to something so important as the shape of the yield curve. So how will the yield curve uninvert, mean revert back to its more normal positive shape? Now, it could do it if long-term rates were to back up. But as we said earlier, where's this growth reacceleration going to come from? And where is this new upward trend in inflation going to come from? I don't see it. So it either re-steepens to its positive slope led by the back end of the curve, which I think is a low odds bet, or it will mean revert because of the cycle. And every single Fed tightening cycle historically was followed by a pause, followed by an easing cycle, and every easing cycle was then followed by a pause and then followed by a tightening cycle. It's just a cycle. And the Fed will cut rates. Short-term rates will fall much faster than long-term interest rates. But because of the convexity and price appreciation, which is going to dominate the total return in the long bond, just getting down 100 basis points, think of that math, just getting down 100 basis points in the long bond gives you a 25% total return. That's the math people should focus on. And that, I think, will be the best returning asset class next year. And it's already starting.
Let's talk about commodities generally. In the month or two that as you said, we've really taken a big hit on crude oil. I noticed Dr. Copper is actually going the other direction. We just retested the 200-day moving average last week. So is there a new bull market in commodities, as some people are saying? And why is copper at such strong odds with crude oil if we think the effect that's happening to crude oil is recession-driven?
Well, I mean, the rebound on copper came after a very significant correction, as you could say, with lumber and a lot of other commodities that we're looking at. So they got dramatically oversold, and they've snapped back. And I think a lot of it is technical in nature, and a lot of it is short covering in nature. There is nothing happening on the global demand scene that should cause you to be bullish right now on commodities. Now, we know that for many of the commodities, we've gone through many years of a lack of capital investment. We know that there is actually a very strongly supportive supply curve for most commodities. But it's the demand side. You can't forecast a price with just one curve. And global demand is weakening. So am I a buyer of commodities? Am I a buyer into this rally that we've seen in some of the base metals or even lumber? How could you look at the home sale number that came out for October? Home sales tanked. You had a big downward revision to September. Housing demand in the United States is going down. And you've got economies in the UK which are flat. Germany looks headed for economic contraction, which is going to have an impact on the entire EU. Japan just posted a negative quarterly GDP reading. We know that the Chinese economy is not performing well at all, and still in a debt morass and a property sector depression that doesn't seem to be bottoming out. And we're past peak growth in the U.S., and I sense that the fiscal stimulus, which helped extend the cycle, is now in the rearview mirror, and all the policy lags from the Fed still haven't played out. And the Fed is going to be slow to cut rates. They should be cutting them, but they might not cut them until we're well into the spring or maybe early summer of next year. They will be deliberately late because they're like the groundhog scared of its own shadow, having missed the big inflation from the summer of 2022. So I don't see unless you're going to say, well, the U.S. dollar is going to weaken, which it has, and that might be one of the reasons that these commodities have done a little bit better, is that the U.S. dollar is off the boil, and that much is true, and these commodities are priced in U.S. dollars. But I think that we are going into a global recession. And I don't remember in my lifetime or before that commodities were a place you want to be parking your investments in the context of a global recession. Commodities, when push comes to shove, are a torque on global GDP. And I don't think that's going to be a constructive story for 2024. Quite the opposite.
I hear you on commodities generally. I just want to check in, though, because in previous interviews, you've said don't give up on gold. Is gold an exception because of its monetary function?
Yes, I think that gold has fewer cyclical properties. It also is going to be a natural beneficiary of two things, because you always have to pay attention to what the correlations are to any specific commodity or any specific equity or asset class. And there's two things that are going to play a role in gold breaking out, and it actually is breaking out, which is declining real interest rates and a weaker US dollar. And I think that's all you really have to know. And if you take a look at gold this year in any other currency terms, it's behaving very well. And I would say that even in the period where the US dollar was performing very strongly, the gold price was actually hanging in very well. So I think that, it comes down to the comment before when I said, well, you can't really invest around the geopolitics. But gold, generally speaking, is a hedge against uncertainty, period. But I put that number 3. I think that moving past the peak in interest rates is very important, because the opportunity cost of holding gold is the coupon that you're going to get in the fixed income market. And so that opportunity cost is now going in the other direction. And it looks as though the bull market in the US dollar is in the rearview mirror. And those are the two reasons why I'm sticking with gold. And actually, that's my second highest conviction trade, which is why the theme for 2024 is going to be the bond bullion barbell, which actually in the past few weeks, belatedly, is starting to work very well. And I think that will be a very nice complement to the portfolio. Exposure to gold and exposure to long duration, high quality bonds.
The one other commodity that I see that seems exceptional, at least in terms of what the price charts are doing, is uranium. What's going on there? Is it telling us that there's going to be a full-on renaissance in nuclear energy?
Well, that's I've heard that for so long. I'd like to believe it, and I think that it should be playing a part in the clean energy revolution. Of course, there's always going to be political posturing against uranium, but I do think, if you ask me, is uranium in a secular bull market? I think that it is, and I would be recommending exposure there as well.
Well, David, I can't thank you enough for a terrific interview. But before I let you go, I want to talk about not just the Breakfast with Dave newsletter, which you're very, very famous for I don't know how many decades now, but also you used to be working under other asset managers. You've founded your own firm, which takes you out of that pressure to always be bullish. Tell us a little bit more about the other services that you've added at Rosenberg Research. And also in past interviews, you've given our listeners a deal on the newsletter. If that's available, we'd sure appreciate that as well.
Absolutely. So anybody who's on the call will get a 30-day free trial for everything we do. And, we produce daily research, weekly, monthly. And the Breakfast with Dave is the flagship that really contains everything that you need to know to get through your day every single day. So it provides you with information, and it provides you with analysis. And it's a combination of small picture and big picture. And it takes the economics and weaves it into investment advice every single day. On top of that, we do special reports. So we'll write on a lot of things we're talking about, secular shifts in inflation, interest rates, countries, China, India, Mexico, and we also touch on what's happening on industry. So it's not just about, stocks, bonds, or cash, and where do I invest around the yield curve? What are your favorite sectors? But we really dig deep in our special reports into what is lying around the bend and what should we be thinking about in the next 3, 5, and 10 years. So, we cover the nitty gritty and get it in the weeds, but we also look at the world from 10,000 feet up in the air. And I would say that for investors in particular, we publish a monthly asset allocation document called the Strategizer. where we actually have recommendations and scorecards on every stock market on the planet. We drill down to the sector level. It's got a bond duration model, how you should be investing around corporate credit. It has a commodity model and an FX model. And we rolled it all into a dynamic asset mix recommendation that we update every single month. So that's called the Strategizer. And I would say, actually, although I've been doing Breakfast with Dave now since 1998, Strategizer, I started when I started Rosenberg Research in early 2020. That is basically caught up. I would say that that's tied as the flagship right now is the monthly Strategizer. And the next one for December is going to be coming out just the next several days. So, yeah, absolutely. And we also do our own periodic webcasts. We do a couple of those a month. So the other thing I would just mention is that for people that are clients of mine, they get access to me. So we have an information box. I probably spend 20% of my day answering client questions on everything, as arcane as shifts in parts of the Fed balance sheet, to what's happening in China, to my view on the US dollar and gold and everything we're talking about right now. I spend 20% of my day getting back to my clients on their questions. So that's an additional service that we offer.
Well, folks, you can't go wrong with a 30-day free trial. You'll find a link in your Research Roundup email in order to take advantage of that. Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com. Energy Transition Crisis, my new video documentary series about energy transition, has finally been released, and anyone can watch it for free at energytransitioncrisis.org. The series explains exactly what it's really going to take to break humanity's addiction to fossil fuels and why it will take longer and cost more than almost anyone realizes. And I'd like to think the 3 episodes on nuclear energy are among the most detailed on YouTube. This is a passion project for me, and there's no profit motive, no revenue, and therefore no budget other than donations. I'd really appreciate your help promoting the series. Things you can do to help include subscribing to the Energy Crisis Doc YouTube channel, liking every episode, posting comments on YouTube, and posting links to your favorite episodes on social media. If you don't have time to do those things, there's also a donations page at energytransitioncrisis.org. The money does not go to me. 100% of it will be spent on YouTube and other social media advertising to promote the series. Thanks in advance for your help. Now let's get back to the show and Patrick's postgame chart deck.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Rosie back on the show. Now, joining us again in the post-game segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the button over Rosie's picture saying, looking for the downloads. Now, Eric, let's get to crude oil, starting with the EIA inventory.
EIA printed a build of 1.6 million barrels, Cushing, Oklahoma building 1.9 million barrels, gasoline drawing down 1.8 million barrels. Distillates was the really big build on the board at 5.2 million barrels. U.S. production holding unchanged at 13.2 million barrels. I'm recording several hours before the OPEC Plus meeting news is expected to come out at around 10 a.m. Eastern Time. By the time you hear this episode, my expectation is that OPEC Plus will have by then announced some kind of cut, or at least an extension of previous production cuts. In my humble opinion, the market has gotten the news out of OPEC Plus exactly backwards for the last couple of weeks. On 3 separate occasions, news out of OPEC seemed to indicate that the members were settling the internal differences that caused the planned November 26th meeting to be delayed until November 30th. On each such occasion, the market sold off sharply on the news because market participants apparently think that OPEC reaching consensus means a new production cut or a calendar extension of the already agreed production cuts is less likely as opposed to more likely. That just doesn't make any sense, folks. First of all, it's important to understand that OPEC decisions are generally made before the meeting occurs. The purpose of the meeting is to codify an agreement between the members that's already been made behind the scenes. Sometimes that agreement breaks down at the meeting, resulting in unexpected outcomes. But generally speaking, the deal has been made in principle before the meeting ever happens. When OPEC Plus delayed the meeting originally planned for last Sunday, it was precisely because they were unable to reach consensus before the meeting. But my real point is that if they were not inclined to cut production, they would have just had the meeting. They wouldn't need to delay the meeting in order to establish consensus because no unanimous vote would have been needed. The only reason to delay the meeting was to give more time to establish consensus, to either cut production or extend the duration of the cuts already agreed to, which are set to expire at the end of the calendar year. Remember, a production cut requires a unanimous vote of the delegates. The reason to delay the meeting was that they didn't quite have the 100% agreement needed on a cut, and they couldn't cut at the meeting until they achieved unanimous consensus of all of the members going into the meeting. News that the squabbles over Nigeria and Angola's baseline production numbers being adjusted had been resolved were an indication that the hesitations that might have led those members not to support a production cut or an extension of the existing production cuts had been resolved. That set the stage for a new cut decision or an extension of the existing cuts. Now, again, I don't know what's going to happen. I'm recording several hours before the news will ultimately come out. But the market's perception that growing consensus means cuts are less likely is backwards. Another important point to understand is that almost everyone assumes that the goal of a cut is to increase the flat price of oil for the sake of supporting OPEC Plus revenue levels. Now, that's likely one factor, but an equally, if not more likely motive is that Saudi Arabia and OPEC Plus want to keep the front of the WTI futures curve in backwardation. It's fallen into contango in the last few weeks, just at the very front end of the curve, the first couple of months. Because keeping the curve in backwardation, or in this case, getting it back into backwardation, discourages inventory builds in the United States and keeps OPEC and Saudi Arabia in the driver's seat. Our good friend Dr. Anas Al-Haji has had excellent coverage and perspective on this in his Substack blog. I think a lot of people have made the assumption because Dr. Al-Haji's Substack blog is now a paid subscription service that all of the posts there are behind a paywall. That's not true. About half of his posts, including all of his coverage of this developing situation, have been free. There's a link to that Substack blog in your research roundup, or just go to anasalhajieoa.substack.com.
So, Eric, just purely on technicals, to me, there's obviously a bounce occurring on oil, but there's a huge hurdle ahead. Now, I have the 50-day moving average on there, which is approaching the $80 level, but this low 80s is where all the Fibonacci zones lie, as well as the descending trend line. So, to me, this is a make it or break it moment for the short-term trend, which is if oil cannot beat this $80, $82 area with any conviction, particularly in this post-OPEC period, then the window is still open for retesting 2023 lows. To me, the bulls, if they really want to turn this, really need to do it here and now with a decisive push into the 80s. At that stage, if the longer we consolidate north of $80, that would be really where the trend could really start becoming your friend for a potential advance in oil. So let's certainly watch what happens here. But moving on, let's get to the equity markets. I want to get Nick involved in this conversation. On page 3, Nick, we have your levels on the SPX. What are you watching?
Yeah, Patrick. So right now, SPX's spot price is approximately $45.50. Now, the implied move for the December 15th OPEX, which is a couple of weeks away and factors in the FOMC, which is Wednesday, December the 13th, is approximately 90 points. Therefore, the upper expected move is 46.40 above that call wall area at 4,600, and the lower expected move is at 44.60, which is below the key support area at 4,500. Now, over the last week, we haven't really moved too much in the S&P, and I'm inclined to think that we see some downside action before some upside action. Reason being is that yesterday, for example, I noticed that there was a lot of call selling as we opened in the 45.87 area of SPX and also corresponding put buying. So what I'm seeing here is a pause by the bulls in being bullish by buying call options, and a perhaps a little bit of hedging in the short term by buying put options in the short term, perhaps in anticipation of FOMC in a couple of weeks. Now, one of the Fed members mentioned yesterday that they might see some more rate hikes. That's speculation at this point. But either way, I think we see a test of the 4,500 area, possibly 4,450, before resumption to the upside.
Nick, in principle, I agree with what you're saying. The part that I'm looking for here is that we have some substantial overhead resistance. A lot of the drivers, that technical drivers that were pushing the market higher and quantitative reasons have mostly played out. And so markets mean reverting and pausing is a very typical thing. You can see the 50-day moving average lies around the 4430 area. The fib zone's also around the 4400 area. So a 100-point pullback at some juncture here would be a very typical pause in the advance, but I think that will initially be bought on dip, driving markets back toward these highs again into a Christmas rally. This kind of a grinding trade range probably is the path of least resistance until we get to the new year, where I think a lot more volatility can come about. Nonetheless, Nick, let's move on to page 5, where we have your QQQ levels. What are you looking at?
Spot price right now on the Qs is approximately 390. The implied move for the December 15th monthly OPEX is plus minus 10 points. Therefore, the upper expected move is 400 and the lower expected move is 380. Right now, we have key resistance at 400, also a call wall at 400, and key support at 380, also a put wall at 380 as well. As I mentioned in previous weeks, I think that we see a pullback perhaps in the tech sector, namely because the larger tech companies are so large in relation to the overall market. So I know we're discussing the Qs right now, but just for reference, the Meg 7 names, that being Apple, Microsoft, Google, Amazon, NVIDIA, Tesla, and Meta, they comprise a combined $12 trillion of market cap, approximately. Now, the total value of the remaining 493 companies in the S&P 500 comprise $26 trillion. So you have 7 companies that take up a very, very large proportion of the overall market. And seeing right now that the buying and call options has slowed in these names and corresponding put buying has increased, leads me to believe that we're going to see some downside perhaps in the short term. I think it's possible we go as low as 370 area perhaps in the short term. I'm also more bullish in the small caps in the form of the Russell, which I mentioned in previous weeks. I think that if the market does run higher, those names have to run higher and faster than the rest of the market as well.
Nick, I want to, though, talk about page 6, where we have the volatility index. I mean, we printed almost down to the 12 level, and we broke all of the summer lows on volatility. Now, I thought this was certainly possible going into December, but I didn't think here in the November month that we would even get down to these levels this quickly anyway. What's your take on volatility?
Yeah, Patrick. So the VIX right now is at a level of about 13 or so, which denotes that we should have intraday high to low moves of about 0.75%. Looking at the chart here, we see that whenever we have a low level of the VIX, somewhere around 13 or 12, we see a corresponding pop within a few weeks of that. So right now, I'm inclined to think that option buyers have the edge here and option sellers are kind of out to lunch. What are your thoughts?
Yeah, it's very interesting watching these very low levels of volatility. But moving on to page 7 here, Nick, I wanted to touch on the 1-year volatility. And again, we are at a level very similar to the summer, where we have seen, or we are at 2-year lows for volatility premium in these long-dated options. I mean, we obviously have seen lower levels of volatility in the pre-COVID period, but it is surprising to see even long-term volatility, because I could see why short-term volatility is cheap. I mean, we're going into 30 days out. We're in the middle of the holiday season. It could be a very low, tight range of volatility, narrow realized volatility. I could see that in the holiday period, but 1 year out to be at multi-year lows is to me an opportunity.
Yeah, Patrick, I'm in agreement. Options are cheap right now, and if you have a larger portfolio that's exposed to the S&P, it makes a lot of sense right now to buy some insurance. Again, you want to buy hurricane insurance when it's cheap, not right before a hurricane hits. And moving on to the U.S. dollar, what are your thoughts here, Patrick?
Well, we have the dollar having hit some critical levels. And not only have we fully fib retraced there, but we've seen the euro testing this critical 110 level. We see the US dollar yen now slowing down from its correction. And so this is a really important moment in my mind on the dollar, because if the dollar was to break all these levels and continue its short-term correction back towards to 2023 lows, that should be a tailwind for risk assets and should really keep things going well for the next month or two. But if for whatever reason, particularly as we go into the Fed meetings in the next couple of weeks, we're going to see a scenario where if the dollar started to strengthen and got back to 104, 105 on the upside, that could suddenly be like a wet blanket on all risk assets that really kind of starts things grinding a bit. And so watching what the dollar does here is just going to be critical.
And moving on to page 9, we have the gold futures chart. What are your thoughts here, Eric?
Well, as expected, we got a nice clean break above resistance at the October highs. The next target is the prior all-time high at 2085, with resistance starting around 2063. And on a clean break above 2085, the measured move target is 2140. The contract roll from the December 23 to the February 24 contract boosted the price on the continuation futures chart, creating a psychological illusion that strength is even stronger than it is, and bringing the 2085 prior all-time high much closer to the market action. That is, I think, a illusory effect. I wouldn't be surprised to see a little bit of a pullback here before we move higher. But I think eventually we are going to challenge and hopefully break 2085. If we do break 2085, it should be a quick trip up to 2140. We'll have to see what happens from there.
Eric, it's interesting that you just mentioned the 2140 level because it is the measured move, and certainly on the continuous charts and spot prices, it would be a break to all-time highs. But the interesting thing is we've now seen a contract roll where the front month contract on gold is in the February 2024. And because of the contango in the gold markets that was there earlier in the year, that February contract has already tested 2140 earlier this year. So while many traders that are watching spot prices would see gold break to all-time highs, if gold finished that move up there, it would actually be just retesting highs on the February contract. With that said, I do believe that gold is in a bullish position and has room to retest these upper levels. I still think that gold will likely mean revert and correct before the really big breakout. And I think that the easing cycle that the Fed inevitably starts in the second or third quarter of next year will probably be the true catalyst that drives gold to much higher levels.
Patrick, in keeping with David Rosenberg's comments in the feature interview about the market getting frothy into year-end, you're hosting a special webinar to explain why today is an extraordinary time to hedge your portfolio for the risk of potential market turmoil in 2024. What will you be covering, and how can people register to attend?
Eric, I strongly believe this is an extraordinary opportunity to protect your portfolio from market volatility in 2024. It has rarely ever been cheaper to ensure the downside risk of your portfolio. So let me give you an example. On February 18th, 2020, just days before the COVID crash you predicted, the markets were trading at all-time highs and volatility near historic lows, yet it cost 5.82%, almost 6%, for an at-the-money $3,400 strike put with 11 months of time on it. Today, a similar duration put right at the money costs 4.18%, almost 30% cheaper. In light of where we are in the economic cycle, this topic deserves a much deeper explanation than a quick mention on this podcast. That's why I'm hosting a free special webinar to go extensively in detail on why I think this is an opportunity our listeners must understand. I'm hosting it on Monday, December 4th at 1 p.m. The link to register is in the Research Roundup email, or directly register at bigpicturetrading.com.
Folks, again, you can find the link to register in the Research Roundup email or visit bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this Research Roundup, you're going to find the transcript for today's interview and the chart book, which is discussed in the postgame, including a number of links to articles that we found interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend. That is Eric spelled with a K. And follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Seresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.